Hey, good afternoon. It is Monday, April 28th, and the market has closed. And the market on the S&P closed in the green. I was really glad to see that. The market now is on a 5-day win streak, which is great to see. Man, it is great to see that. We've had a rough 2025. If you look at from February up until maybe a week and a half ago, the market was really selling off. And now seeing that we've got 5 days in the books that have been green, heading into some big earnings that we're going to review real quickly, is in my book, um, we're in a good spot. Earlier in the day when we were trading, it didn't look so good. You see how the market sold off, and we were looking like, hey, we're going to start the week on a negative note, which I wasn't too worried about, because I'm like, well, if we have good earnings, that'll recover the market. That'll cause stocks to really go up. So it ended up that the market did rally. I mean, intraday, it rallied 1% from the bottom. That's a very good sign. That's excellent. So good job, stock market, for it really coming back. It was good to see. Good to see you, Anthony Ferguson. I hope you had a good day today. So I am counting it as a win today, 5 days in a row. That is excellent. The Russell was up. The NASDAQ was down a tiny bit. The Dow was up, probably the best out of the indexes. So that is excellent. So earnings are going to move the market. There is one economic report that I think could move the market quite a bit, and that is the GDP report that's going to be announced on Wednesday. It's going to be announced in the morning. And GDP, the consensus is it's going to come in at 0.4, showing that we're just barely growing. And if that guy comes in negative, it could just, kind of psychologically get in the market's head, and we can sell off. We'll see. So that's the one report that I think can move the market. But what will definitely move the market are earnings. Earnings are going to be abundant this week. We have all these earnings that happened today. I'm going to come back to them. I'm just going to show you what we've got in store for tomorrow. A lot of earnings. These are bigger companies, and it gets even bigger. Wednesday, massive companies. Thursday, humongous companies. And this is what's going to dictate the market. And then even Friday has some big players: Exxon, Chevron, Shell, Unilever. So we're right in the middle of it. If you enjoy the game of stock investing, the art of stock investing, you're in luck. This is kind of playoffs. This is intensity. This is the good stuff. And I hope you're enjoying it. So we have these earnings. I got kind of like the highlights that I want to go through and look at some of these companies. Let me catch up on a comment here from Anthony. So pretty neutral, mostly selling stuff. Yeah, I was in the same boat. I didn't do much trading today. I'm kind of waiting for the shoe to drop, which is earnings. So I'm kind of in your boat. I'm willing to say that, most people are probably in the same boat. Just kind of wait until we get some data from these companies. So let's take a peek at some of these earnings. We're going to go from the biggest cap to the smallest cap. Welltower. This is a residential wellness and healthcare infrastructure company. And I believe they are a real estate investment trust. Yep, a real estate investment trust. So they provide properties for people that are retiring and are going to live there. And that's big demand, right? We've got a lot of seniors that are retiring, and they are doing great. Year to date, Welltower is up 18%. Over the 1 year, up 57%. Wow. And over the 5 year, look at that consistency. Just a really, really good looking performance. They're a $96 billion market cap company. They are a little expensive. They're 12 times revenue for this real estate investment trust. Real estate investment trusts usually, and the way I value them based on their dividend and earnings per share. This is the one exception that I look at dividends. And the reason for it is you're essentially buying into funds from operations, and those funds from operations, there's a rule on REITs that they have to be distributed. And that's why I make the exception on REITs to value them based on the dividend. And you can see that the dividend is quite low. My real estate investment trust that's probably very similar to them is CTRE, and I believe they have a much better dividend rate. But this one here, on an appreciation perspective, boy, look at that appreciation. I don't really care about the dividend. This one has been a winner. So the PE ratio is really high. So it looks like people are really buying into the expectation that these guys are just going to have demand for a long time. Can't argue with that. Their growth is really good, 21.5% for the full year 2024. So these guys announced today the stock is up. And they announced after the market close, it's up in the after hours. So that looks good. All right. Nice real estate investment trust is getting it done for investors in that company. The next biggest company is Waste Management. And this one here is kind of a safety stock. A lot of people went to it when a lot of these technology stocks and so forth were being sold off. And these guys in after hours, because these guys announced, they're being sold off. And these guys are expensive. I've looked at these guys in the past, Waste Management, and it's just a little too expensive. I don't get a lot of cash, not enough to value the company above its current market cap. So this one has been a pass for me for a while, but it's been a winner for investors. If you're in it for 5 years, you doubled your money. So, but for the past year, it's up 9%. And in this environment, that's a winner. And year to date, that's absolutely a winner at 13. So Waste Management looks good. So it looks like, Anthony, you want to look at IBOTA? Glad to take a look. I'll put that on the list. All right. And you just sold your Waste Management. Interesting. And hopefully you're taking a nice gain. And you've got a question here. Macro question, Victor. Do you see much manufacturing returning to the U.S. or maybe Mexico instead? I think that the short answer is certain manufacturing will, and especially manufacturing that requires skilled labor. I think that could return. But when it comes to, like, apparel, we just can't compete with some of these low cost producers. It's just too hard. I should just say it's not in the numbers. And like toy manufacturing, I don't think anybody in the US would be willing to work for the amount of money that would be available to pay people to make toys, because toys are, for the most part, a pretty inexpensive product. And Asian countries do it. They do it well. And it's just really hard to compete in those spaces. But if you go into manufacturing of, maybe heavy equipment, more value add, higher price products, yeah, I think so. I think we can see that type of manufacturing returning to the US. All right, so moving along, I'm going to do a flyby on earnings. Cadence is a software company. You actually use Cadence to design, to test semiconductors and help you design semiconductors. These guys are a pretty valuable outfit, $78 billion, but they're being sold off in after hours. Year to date, these guys are down 5% because semiconductor has been down. Over the 1 year, it's just up 1%. So it hasn't been an absolute winner, but the 5-year looks awesome. That looks great, up 251%. It is an expensive stock. It's trading at 74 PE. That is expensive. So the market, it looks like these guys are growing, but man, you've got to be growing a lot more to fit into that 72 PE. And their cash flow, let's take a look at that, has kind of been not growing. If you see that cash flow over the last 2 years hasn't moved. So that is interesting and kind of a limitation. The best I can do on this one's probably value it at 25-30 billion dollars, and the market cap's way up there at 78. So this one's just a little too expensive. So, and I got the correction there, Anthony. I'll look at IBTA. All right. So cadence is down. So we have earnings calls, and it's this is going to help us get warmed up for the week. The big surprise stock is NXT Semiconductors. Looks like Semiconductors is going to have a bad night, and they are down 7% in after hours. Market cap of 49.7 billion. Strong buy, discounted by 30%. The big news here was their CEO is going to retire, and these guys are out of the Netherlands, and they sell semiconductors. The 1 year, they're down 19%. Year to date, they're down 5.5%. Over the 5 year, up 102%. So it looks good for the 5 year, but the 1 year, not so good. So this one's going to have a rough night. We'll see how it does tomorrow. And so far, I've looked at 2 semiconductor industry stocks. They're both going down. So NVIDIA had a terrible day. Huawei, the news on Huawei. Huawei is a competitor in China, is producing a chip that they believe rivals the NVIDIA GPU performance. So we'll see if that's a fact. And the last one with earnings is Domino's Pizza. And this one here is up a little bit. For the past year, it's down just a tiny bit. And over the 5 year, it's up 35%. So this one's kind of a safety stock, right? You have pizza, and pizza is kind of an affordable meal. And these guys could probably do well in recession or just about in any market. So Domino's Pizza announced their earnings. So the earnings are a lot of them are happening. The names are recognizable, but not real giant names. It's going to be the rest of the week that really starts to move the market. Beginning tomorrow, we have some big names tomorrow, but the big names will be Wednesday, Thursday. Those would be the huge companies. I'm looking forward to that. So let's start looking at some of the stocks that were requested, starting with IBTA. So that's Ibotta. Ibotta is a technology company, provides digital promotion services to clients in the United States. The company sources digital promotions from its clients, primarily consumer packaged goods brands, distributes these promotions to consumers through its network of publishers enabled by Ibotta Performance Network. Okay. So these guys sound like AppLovin or Buyant. Year to date, they're down 25%. They're down even more for the 1 year. Interesting. Okay. So P looks good. Really, it's a small cap, 1.44 billion. Revenue is 367. So they're, call it 4 times revenue. Not bad. Let's see what the growth is. So we have 3 years to work with. The growth did come down. They were at 52% growth. Now they're at 14. They have a contraction quarter in the fourth quarter of 2024. That could be a little concerning. And okay. They had really good growth the year before. And when you're these small companies, right, sometimes they have a product that really does well, but then the competition will adjust and compete for that business more effectively. And I'm sensing that might be going on here. 14% growth is still good, but to see it come down from 52 is a concern. So 1.44 billion. Let's take a look at their free cash flow. 115, that looks good. I would probably multiply that times maybe 20, since they have that 14% growth, and then deduct any debt they have. So 20, that would get us to about 23 billion in market cap value. And let's see if they have any debt. So debt level, they don't really have debt. They have a lot of cash, 350, 349. They have like 1.5 of debt. So you'd actually add this. So we're at like 23, 24 billion. Am I getting that right? Or 2.3, 2.4 billion. Sorry, my math is incorrect. So if I multiply this times 20, it would be 2.3 billion. Still a very good discount. This stock is discounted. This is definitely discounted, but what you have to make a decision on is, are they going to grow? That's the big question. When are they going to announce their earnings? May 14th. So we're 2 weeks from that happening. And there's also, looks like there's some kind of lawsuit going on. I'm not sure what that lawsuit's about. That you should definitely get caught up on that. But what I would say is really important is you need to get a strong handle on, are these guys going to grow? If you feel they're going to grow 20, 30% going forward, this is potentially a really good idea. If you think they're going to continue to slow their growth, they're going to grow from 14 down to 5, they're going to become irrelevant. And I think the stock's not going to do well. The market's already selling it off. And it's not a pretty picture. I mean, the 1 year, 54.8%, that's a big, big sell off. So I think some companies that are similar, that are doing better, are AppLovin and DSP. Now, both of those stocks have been going up, so they're not highly discounted anymore, but they're good compare companies, good peer companies. And you'll have to make that judgment call on how is this company going to grow? And if it's going to be high growth, 20, 30%, man, this looks good. If they're going to continue to slow down, this looks bad. Good balance sheet. So that's my expectation on this one. 10 analysts cover it. They think it's highly discounted. They're going to be very profitable, looks like. So revenue growth is going to slow down this year, and then it's supposed to pick up. But you need to make that call. These analysts, I wonder why it's slowing down and then picking back up. Why is that? And then their earnings per share did come down quite a bit, but then it's going to grow. So interesting. And the PE is really flying up because the earnings per share has really come down. So this is a nice small cap, but it's risky. I think what's nice about having a bear market is that it's provided better pricing on a lot of good stocks. And that makes, finding stocks that are discounted, better. Like there's more fertile ground to examine. But it doesn't mean that all stocks are good. You first have to understand the business. If this business surprises to the downside, it's going to keep losing its price. So that's what I would put out there. Thanks for asking on that, Anthony. Shadow Guy, what's up? How you doing? And you asked me about manufacturing returning to the U.S. and Mexico. Thanks for the question. All right. Yeah, have a good night, Shadow Guy. Yeah, good. I'm glad that you're doing your research on iBoda. Thanks for the tip, Shadow Guy. ETF AVEE. Let's take a look. So AVEE. So this has a lot of small caps. And I think some of these are in Asia, right? So emerging markets. Yep, that's what it is. And how's the performance been? Year to date, flat. 1 year, flat. 5 year, flat. Dividend yield 3.27. Interesting. So it's got a lot of small caps in emerging markets, a lot of stuff in China. Interesting. Right now, I'm investing in a ETF, but it's most of the big caps. So it's Alibaba, Pinduoduo, and all those big companies in China. And I think I'm going to stick there. I'm already taking a risk investing outside the US. I don't want to go even further and going emerging small cap. But hopefully this works for whomever would be interested in it. I would hope that it really works for you, but it's not for me. All right, so that is the ETF. Cool. Looks like Kathy Wood's an investor. Great. Android PC gameplay. How you doing, man? Good to see you. Thanks for joining. Brandon, how do you evaluate bonds? So that's it. Let me answer that question. And so we're predominantly looking at stocks, right? And we look at stocks. Stocks are more difficult. Bonds are simpler. And let me kind of go back to, let's say, waste management. That's an easy business to understand, right? You have a market cap, you cash flows, earnings per share, and you're trying to find a stock that is being priced below its intrinsic value. And you're trying to really nail hey, the stock appreciated and I made money on appreciation and so forth. Bonds are loans and they're simply put together. When we look at let me try to find an example. I could just talk through it then, because I'm showing an example of a bond is hard on the fly. But basically, like I started buying into a bond that is a bond that has a 5-year term, and that term is going to go 5 years, and the interest rate on that bond is 6.5. So when you look at a bond, you're going to be looking at a couple variables that are important. First and foremost is the company. Do you believe that company is going to be around for the term? And in the case of the bond that I bought most recently, it's the power company in California. I'm familiar with them. Can they run into some problems? Yeah, but I think they can probably manage their way out of those problems. And I think that they're going to be around. They're going to definitely have more demand than they can fill, so no problem there. So the company's good. The next area is your term. There's term risk. 5 years is riskier than 5 months. 5 months is a shorter term. So over 5 years, I want to get a higher rate of return. In that bond there, I'm getting 6.5. Now, what's good about bonds is I don't have to try to predict, if this stock is going to, like a stock, I'm trying to buy stocks that will be worth more in 5 years. Well, with bonds, no, we're not having to do that. We're going to make 6.5%. Bonds in a portfolio are meant to reduce risk and increase predictability. Hey, that bond's going to pay me 6.5% every year. That's the coupon rate, and I'm going to be given that kind of income. So I evaluate a bond on the issuer, the company, the term, fitting that into my game plan. I'm looking for 5-year yields because I already have a bond ladder, and a bond ladder is basically I own bonds that are going to mature in 2025. I have bonds that are going to mature in 2026, 27, 28, 29, and now I'm looking to fill in 2030. That way each year I have bonds that are redeeming. Okay, so I'm looking at company, I'm looking at term, and I'm looking at rate of return. I want to get a market rate of return. This is a corporate bond. It's going to pay me 6.5. Okay, great. And it's actually 6.25 is what I'm getting. So it's far simpler than a stock. what's important to cover is why would you own bonds, right? Well, you don't want to own just stocks. I mean, you can, especially if you're young and you're like, hey, I've got 30 years before I think I want to retire. Yeah, okay. I couldn't argue with that. Go for it. All equities. But as you if you want to shelter a part of your portfolio, not have it be completely at the risk of the market. So when you have years like the one we're having, if you have a portion of your portfolio in bonds, those bonds will actually rise in value potentially if stocks are failing, and it really holds its value far better than stocks. So that's the reason to own stocks. So own bonds, excuse me. That's the reason to own bonds in an overall portfolio. As investors get older and you're, approaching certain milestones like, hey, I want to retire. Okay, great. You got to start locking in like where's your income going to come from over the next 5-10 years? And stocks are great. I'm always going to own stocks, but you want to start putting in some fixed income, very predictable investments in there as well. So those are bonds, and I've got a couple bond videos on the channel, and you might take a peek at those, and keep asking questions. So let me see your comment here. Okay. Yeah, so that's a really good thought, which is you're building, you're saving up your money in as you plan to buy a house. Okay. If putting money into money markets are going to pay you like 4% right now, but if you do have kind of a, hey, I'm going to buy that house in 3 years, you might be able to get a little better yield. And I would encourage you to go with an ETF that maybe has an intermediate term ETF, because that's going to give you automatic diversification. Bonds, like individual stocks, take a little more homework. And if you buy one bond, it's greater risk than if you bought an ETF, because that ETF spreads the risk across 200 bonds. So it's pretty much super safe. And you'll probably make close to what an individual bond would yield, maybe a little less. And that's probably what I would do if I'm looking at like, hey, 3 years from now, I want to buy a house. Is start looking at ETFs that are intermediate term. For example, I think, let me see, BSV is short term. This is 1 to 5 years. This is maybe an idea that you can think about and take a look at. So this is going to pay us two things. Over year to date, this is up 1.7%. See how it went up. And it didn't go up like 20%. It just went up 1.7. But that's because the market's actually going down in value. And bonds tend to go opposite direction to stocks. And if you go 1.7 plus this dividend yield, we're up above 5%, which is a better rate of return than a money market account, which would be at 4%. And as interest rates continue to go down, especially as the Federal Reserve tries to lower short-term interest rates, the first place we're going to see that is in these money market accounts. They'll go from 4% yield to 3.5 to 3. And that's when we have to start putting our thinking hats on and get to an investment that's going to pay us a better rate of return. So that might be an idea that you might take on is, hey, look at the Vanguard short-term bond ETF or similar ETFs that give you just very quickly, it's diversified. It's diversified across treasuries. This one's a very safe investment. You also have some of these when you invest in bonds that are issued out by the US government, that's really low risk. Great. If you go to corporate issued out, these are corporations that issue them out, you'll probably make like 1% higher yield because you're taking a higher risk. And that might be something you would think about. I'd probably go with this one because I want to buy a house. I think the timing on real estate is pretty good, by the way. I don't know if you're following the data, but I did hear that in the month of March was the slowest unit sales month that we've had since 2009. In 2009, things were tough. What I'm hoping for people that want to buy houses is that's beginning of a trend to see that is going to have lower prices of homes. Then people that are looking to buy can buy at a lower price. That'd be great. So we'll see. Fingers crossed. Cool. Thanks, Brandon, for asking those questions. All right. So we covered bonds, ETFs. Now, there was 2 more requests that were provided by another member. All right. And first one is going to be DVN. I believe that's Devon Energy. And energy has been kind of in a weird place. Oil prices have come down, but more recently the stocks have been going up a little bit. But still, year to date, Devon is a little down. The PE is super low. Forward PE is low. Really nice dividend. And excuse me for 1 second. Got a bunch of people calling me. And I just want to let them know that I'll call them back later. All right. So we've got a forward PE of 7. That looks good. Dividends 4.15. That looks good. And this is why, like, we just covered bonds, right? Why would you buy a bond ETF versus a dividend paying stock at 4%? Is because of this. You don't want to lose 40%. You want it 3 years from now, and you want to put that down payment. You can't have 40% of your investment evaporate. You don't want that. You want it to be there. That's why we want bonds in our portfolio. If you need that money in 3 years, fixed income, low risk. This one here is higher risk, but it may be setting up to really go places. This stock, when oil prices go up, boy, Devon Energy is just going to fly up. This one went from $9 a share to, oh my gosh, $77 a share. Wow, that must have been awesome for investors. But since then, it's really kind of just been coming down because oil prices haven't been all that high for the last couple of years. So energy companies have really lagged, especially technology companies. So is this one here getting set up to rally? Well, I've been buying into Occidental. So I'm going to say that this isn't a bad situation. This is a good situation for somebody who wants to buy a good risk reward situation. If we have oil prices click up 10%, 20%, Devon's going to make money. These guys are well run. They're, subject to the oil price, which will change their revenue amount. If oil prices are higher, they will see greater revenue. If oil prices are lower, revenue goes down. And their free cash flow, let's take a look at that. So free cash flow is positive up until now, negative. But I would probably take an average and work with that versus taking the most recent year or the trailing 12 months. Just because that'll give us, kind of an average, that takes into account more of an average oil price that was that existed in the market over those years. I think that's a better way of doing it. That's how I did Occidental. And this one here, $20 billion. These guys, if I look at the average free cash flow, just doing it quickly in my head, you've got the last 6 years, they've probably have averaged 1.5 billion in free cash flow or so. And yeah, I don't think it's going to go down much further. And you've got that 4% dividend. And oil prices are, I think they were low 60s. So let's take a look at oil prices real quick. We're at $62 a barrel. That's kind of low. We are heading kind of in a recession. So I would say that on Devon, I would wait until maybe some of these tariffs, the tariff kind of negotiations get settled, and we know that okay, tariffs are behind us, and then we know how this recession is going to affect us. Is the recession going to be big? Is it going to be deep and long, or is it going to be short and shallow? Because oil and energy is a consumption, market. If we have a go-go economy, people are driving more. Truck drivers are driving their trucks. Uh, Railroads are using more diesel. Airplanes are being flown and they burn more jet fuel. Well, if you study like UPS, they are not doing well. Union Pacific, not doing well. So you have a lot of logistics companies that are kind of sharing with us that, hey, we're slowing down. Airlines are saying that a lot of domestic travel is being canceled. International travel is going down as well. So there's going to be less jet fuel being consumed. So those things tell me that maybe waiting a quarter or two to see where energy is going to go might be a good idea. So that would be my comment on Devon. I don't think it's going to go down much more, but I think buying now, your money just may be sitting around not doing anything for 6 months until we know what's going to happen. So that is Devon. And then the other one was NVO. And NVO is Novartis, or Novo Nordisk, excuse me. And Novo Nordisk is going to announce on May 7th. So that's going to be a week from Wednesday, I believe. And this is a $280 billion market cap company. They are down 50%. Look at that. It went up and then came back down. Wow. This is a dividend payer, 2.57. They have been growing. Isn't that interesting? So this is in the Danish currency. And let me take a peek at their trailing 12 months free cash flow. And that is $11.28 billion of free cash flow. This is in US dollars. This website converts it. With that kind of growth rate, this is, multiply times 20, where we get up to like $230 billion minus debt. And what was the debt level? So they have $10 billion of debt. So let's call it $220 billion of value. They're at 280. So this is a tough one. We're down 50%. Obviously, the momentum is against Novo Nordisk. It's outside the country. For me, this one's a pass because in healthcare especially, there's a lot of really attractive stocks that are discounted. It's a clean discount. You could see it. And Novo Nordisk is right there, right? If you gave them a more favorable, maybe you multiplied the free cash flow by 25, you'd get to that 280. But that's just not enough. I'd have to see a more substantial discount, especially seeing that the market sold them off by 50%. Maybe the market was right. Hey, you guys really were a $50 stock and the market took you up to 140. Now it's bringing you back down to 50. Well, that's a painful ride for some investors that bought up here. So this one here, I think, is a pass for me because there's many options in healthcare that look really good. The healthcare space didn't participate in the big rally in 2023 or 2024. So those valuations are very easy to get to discounted stocks. So this one here would be a pass for me. There's other healthcare stocks that I like, especially some small caps look great. And we'll see. One stock that's going to announce this week is going to be Pfizer. I think they might be announcing tomorrow. Yeah, they're going to be announcing tomorrow. These guys announced before the market opens, if I remember correctly. Look at this dividend, 7.5. And if we look at the quarterly growth rate, 31%, 22%. If they come in with a 25% growth rate, I think the stock's going to rally. The revenue has been going up, which is good. They're profitable and they pay a really nice dividend. that they can afford. So this is an example of, well, instead of buying Novo Nordisk, I'd rather buy Pfizer. I'd rather buy Catalyst. Rather buy another healthcare stock that has a similar, pharmaceutical profile. And I just feel like I'm getting a better discount, I have better upside, fewer risk factors. With Novo Nordisk, the market is telling investors something. It does not like something. you know, a lot of smart money's in this stock, and they're selling it. And I don't know how soon investors are going to warm up to buying this stock again. You might want to let it go and everybody forget about it for a while, and then people start buying it. So Bushy 1147, good to see you. Thanks for attending, and thanks for all the members that support the channel. I appreciate it. So Novo Nordisk, I guess you're referring to this guy, Novo Nordisk. Looks like Eric Johnson. How did you arrive to your equation to value companies blended? Yeah, it's a good question. Let me answer that, because with so Novo Nordisk has a patent on Ozempic, which is facing stiff competition. Yeah, I think the weight loss category is just getting a lot of like new players. We'll see how it sorts out, but you're right. I think that's the big story. So now back to the question of when we look at, so some investors just look at free cash flow. I get that. And they just look at free cash flow and arrive at a valuation. For example, Uber. You can arrive at the intrinsic value of Uber would be $319 billion based on their cash flows and the forecast that I've put together. And this is 2/3 of and let me get to the 2/3 versus 1/3 later. Now, what I was finding in my evaluation of companies is some companies, especially the young ones, maybe aren't at their full free cash flow generation phase, but the company is really nicely profitable. They have good growth. So I just want to know, the market will value stocks based on earnings per share really more often than free cash flows. This is more difficult. This is easier. It's just one formula. Here it is. You just need earnings per share. You need to establish a PE, a growth rate, and you're good to go. Here, you're building a forecast. You've got growth rates going on. You make a lot of decisions as you build this forecast. Then you have more numbers to deal with here. So what I was finding was, if I just go with this number, I feel like I'm not covering the company holistically enough. So I wanted to cover both. But I still believe that free cash flow is the principal long-term valuation metric that I want to focus on. So I want that to be 2/3 of the blend, and then 1/3 of the earnings per share valuation. That's what I wanted to do as an investor. You can take my model and you can use this portion. If you like earnings per share, you can use this portion. If you like free cash flow, or you can use the blend like I do, or you can change the blend 50-50. You can do whatever you want. Once you download the model, I mean, you've got what I hope my model is an example. I would encourage you to always, whatever model you're using, understand every single number, every single calculation. And then when you know the mathematics and you understand each fundamental, you really understand that company. So that's my answer to your question. Good one. Thanks for asking. All right, cool. Over time, you guys keep asking better and better questions. All right, so we covered a good number of stocks. We got earnings going on. And I think I covered the economic data that's coming. GDP is coming on Wednesday. Again, that's just going to add to the stew. Like, if it comes in really ugly news, it could be a problem. If it comes in as expected, I think it's going to stay out of the way. This week is going to be about earnings. And tomorrow, let's see, is Pfizer announcing? Yeah, before the market opens. So that's probably going to be a stock that I cover first thing in the morning. I might even stream in the morning because I want to cover Pfizer. I want to cover Visa. Well, Visa's after the market closes. Coca-Cola, AstraZeneca, another pharmaceutical company, Novartis, HSBC Bank, S&P Global, Honeywell, Spotify. All right. American Tower, another real estate investment trust, Altria, which is the cigarette company, UPS. That'll tell us about the economy. There's a lot of stuff going. So I think I'm going to stream in the morning, kind of get that sorted out. And then in the evening, I don't think I'm going to stream tomorrow evening. And actually, better check myself. Tomorrow morning, I have the member call. So I will definitely cover earnings with members. And that's what I'm going to focus on in the morning. And in the afternoon, I'll see if I can stream. And then Wednesday morning, I can probably stream. So that'll be my schedule. All right. So I am really glad that we had a decent day today. I was a little nervous that, you know what, I've got my fingers crossed, right? I'm a long-term investor, and I know that investing comes with adversity, and we know that, hey, there's gonna be some ugly times. Like 2022 just a process of, well, this market cut us a freaking break. It just kept going down and down, and it fooled us a couple of times. Oh, here's a rally. No, there isn't. Then it finally, went up, and then when it went up nicely. Well, that's just, the price of admission to being an investor, because we want to be a part of this. We want 95% rate of return, right? And we're going to have to deal with some ugly periods. So, all right, this one's ugly right now. Now, I've got my fingers crossed that we can break through and maybe just start to rally a bit, maybe just protect our portfolios for a little bit. I am this close from my portfolio being in the green. I'm slightly in the red. So I'm like, oh man, if it's just, just eclipsing into the green, that would feel better. And it feels like the portfolio is well diversified. So we'll see. We'll see if the earnings can come in positive and make this market go up. Herdo, good to see you, man. Very good to see you. All right, guys. So we will keep it short and sweet. There's no other questions. I will end the stream. Wish you guys a really good night. And members, tune in tomorrow for the member call. It's a conference call, so we can look at stocks, talk them through. And then for everybody else, I'll try to stream in the evening, similar to this. We can catch up at that time. All right, guys. Good luck with your investments and have a good night.